These are 8 types of condos that you need to avoid at all costs. Too many buyers try to cut corners and save money where they shouldn't, and they're stuck with a condo that they either regret buying or they can't sell. So in this video, I'll go over those 8 types of condos, why you shouldn't buy them, why people buy them, the things to avoid, and stick around to the end because I'll show you how you can save money, get a good deal, and make a smart investment. Number 1 is micro condos. These are tiny condos, usually under 300 square feet. And I know there's a big trend with like that minimalist lifestyle and these tiny condos, small living, etc., etc. People buy these because they are the cheapest way to get into a market. And they're really desirable for that trending minimalist lifestyle and could be pretty good for investment returns. But you will face issues in the resale market because the buyer pool for these types of property are so limited. There's not that many people that want to live in a tiny space for such a long period of time. For example, when somebody is wanting to purchase real estate, they're thinking about the long term or at least a 3 to 5 year mark. And with a tiny home like this, any changes to your lifestyle could have a big impact on how much space you need, such as whether you have a pet, you get a boyfriend or a girlfriend that wants to move in with you, a growing family, maybe you have a kid. A under 300 square foot condo is not going to cut it. And you may be on the hook for some losses if you did need to sell in the short term. And one thing I've heard as well is banks may not finance such a small home, meaning either you need a big down payment or you're going to have to pay this thing in cash. And one argument for these types of units is the rentals. And yes, the price to rent ratio may be very desirable, but I see a lot of investors use these as Airbnb units. And if there are restrictions to short-term rentals, you're seeing a big cut in your monthly revenue. The better alternative is if you're looking for a small unit, opt for at least 400 square feet. I see a lot of very efficient studio floor plans at about like 380 square feet. That way you'll have better livability and better resale value. Second on the list is ultra low price pre-sale or pre-construction condos. And people buy these units because the price looks like a steal compared to other pre-sales on the market, especially if you get in early because you can see way more appreciation before completion. But oftentimes these pre-sales are cheap for a reason. Oftentimes these projects have unknown developers or an unknown construction crew that may cut corners during construction. And if the developer is less established, there's a higher risk for financial downturn because the developer may not have as much access to funds and may go bankrupt, unlike another developer that can borrow on other projects and maybe have better relationships and deeper pockets when it comes to lending. There may be more opportunity for delays and cancellations for those exact same reasons. Oftentimes, if they're not used to building this scale of project or they've never done it before, then they may not have the processes and systems to build something as efficiently as they think they will. And if the market drops and these more premium established developers are selling their product at a similar price to these unknown developers, you may be stuck overpaying for a unit that is not worth what you originally paid for. So the better alternative is, I'll give this in 2 parts. The first is work with established developers with a known track record, high quality builds, few delays, few complaints from the end users, the people that end up living in the building themselves. And then 2, if you are working with a less known developer, then do your due diligence before you commit to a purchase. Because oftentimes these contracts can last 3 to 4 years, and you want to make sure that before you commit yourself to that long, it's with a developer and a builder that you can trust. Number 3 is a leasehold condo. Essentially what this is a condo built on land that you don't own. Essentially you're renting the land from government or a corporation, and you pretty much own the exclusive right to use the property. So it's kind of like ownership, but without owning anything. So why do people buy these properties? Well, they're usually 30 to 40% cheaper than typical freehold condos. And then sometimes these units can be located in prime areas that can otherwise be unaffordable. For example, close to universities or some areas of downtown. So yes, like I mentioned, the main negative factor is that you don't actually own the land, meaning the property actually loses value over time as the lease term gets shorter, whereas typical real estate will appreciate greater in time because there's such limited supply. If the lease were to expire, you could lose the unit entirely or be forced to pay some kind of renewal fee, which can be pretty expensive. And then some banks won't even offer a mortgage on leasehold properties, making financing and getting the funds to finance the deal really expensive or difficult. So if you're set on a leasehold, I will say make sure that you're getting a huge discount and is well below market value to better protect your interests. But more importantly, make sure it's a really long-term lease, so over 50 years left on the lease. But I personally have not been in a scenario where I would recommend someone to buy a leasehold property over a freehold property. Number 4 on the list is a condo with too many investors. So people buy these types of units because investor-heavy buildings often have cheaper units, usually due to the high turnover or there's more wear and tear on the property. And oftentimes these investor-heavy buildings are built without all the extra bells and whistles that you'd find in some end-user focused homes. So not as expensive finishings, not as expensive appliances, fewer amenities in the buildings themselves, making them cheaper to operate and run. But a few reasons you should avoid these buildings entirely is that, for one, strata fees tend to rise very quickly. This is because there's a higher wear and tear on common property. Usually it's because tenants don't have the same level of care that an owner would or an owner-occupied property would. There's also less of a community feel, so it's harder to build relationships with your neighbors, especially if there's a lot of turnover with the tenants and you're seeing a lot of different people coming in and out of the building. And then lastly, the banks may treat the financing differently if the building is mainly rentals or investor-owned properties. So it would be important to review the demographic of the building before committing to the purchase, especially if these things are important to you, like if you're an end user that wants to live in this home. At the very least, look for a building with a good balance of owners and renters. Number 5 on the list is buildings with ongoing lawsuits. And this is actually more common than you think. Sometimes the strata will sue the developer of a new build if something that they built is not working or is broken and they need money to get it fixed. Or sometimes there will be lawsuits from within the strata. Maybe one of the owners is suing the strata or vice versa. Either way, it is not uncommon for a building to have an active lawsuit. But the reason you need to avoid these types of condos is if it is a red flag for the lender. Because sometimes banks and lenders won't even give you the money to purchase a property if there are active legal disputes. And usually it depends on the type of legal dispute. You're also sometimes paying higher strata fees or special assessments, like they're taking money out of your pocket to pay for legal fees, retaining lawyers. Sometimes the lawsuits are due to financial mismanagement. So it's really important you figure out what's happening on that side and understand the costs associated with that. But it is also extremely important to consider the resale value, because sometimes lawsuits and legal disputes can be going on for many, many, many years. And if you're buying into this home, you want to make sure that your resale value is not affected and that buyers won't struggle to get financing when you do decide to sell. So unless you know specifically what is happening with the lawsuit, maybe you have some insider knowledge that can help determine what is happening with the lawsuit, then it may make sense. But more often than not, I will recommend not going through with that building and just finding something else. Okay, 3 more. Number 6, buildings with a history of water damage or leaky condo issues. Every time I work with a new buyer that's looking for a condo, the first thing they start to send me are these really cheap condos. And by cheap, I mean insanely cheap for the area. And before even looking at the listing, I can tell the buyer this is a leaky condo. So yes, usually these types of homes are extremely cheap, but they often require hundreds of thousands of dollars in repairs. And these types of fixes are not cheap because they deal with rot, mold, foundation issues, structural issues, pretty much the key parts of a building. You're going to have major insurance issues and then major financing issues because some of these buildings you can't even get insurance or you're paying extremely high premiums. And on top of that, banks usually don't lend money for buyers to buy these types of buildings. So either you're going to have to pay all in cash or you're going to have to find some private lending options, which can get pretty expensive, meaning you're foregoing all of your savings. And then on top of everything, you're also facing struggles on the resale side because banks and insurers will carry a history of buildings with leaks and water damage. It is very easy for buyers to see whether or not a building has had a history of this, and they'll usually opt to avoid it for all the reasons I just mentioned. So the only time I would consider anything like this is if it had been fully remediated and the financials of the building are totally solid. Number 7 is an aging building with no reserve fund and low fees. And with this one, I may be a bit of a hypocrite because I have already sold buildings like this. I've moved some of my buyers into buildings like this, and I've even considered purchasing a unit like this myself. And first of all, the reason why people will opt to purchase a unit like this is because you can get a really cheap unit in a really good area. And because the strata fees are low, your monthly expenses are low. And if you're planning to rent the unit, your overhead is lower. And if you're living in the unit, well, your monthly expenses are lower. But one main reason you need to avoid this is because big repairs are usually coming. Older buildings need new roofs, new plumbing, new cladding, exteriors, elevators. The list goes on. And usually if there are low strata fees, it means when one of those issues or repairs does come up, the owners are paying massive special levies straight out of their pockets. But then you also face resale issues because tell me what kind of buyer would be thrilled to inherit all of these issues and repairs in a building with a low contingency reserve fund, so a low savings to pay for these repairs. Not very many buyers, I'll tell you that. So now why would someone buy? Like, when is this okay? So first of all, when the price does reflect the condition of the building. So if you're able to get a stellar deal on this, you understand the finances, and you're purchasing with enough equity to cover the financial risk, it may be a solid purchase. But beyond the finances, you need to understand what is happening to the building down the line. A building of this age in a prime location may be perfect for a developer to purchase, meaning the strata will probably agree to not make any major repairs and really wait things out until they can sell to a developer. So a few scenarios where this does make sense, but there is always risk. And number 8 on the list, overly restrictive strata rules. When you're buying a condo, you're also buying into the strata. And stratas can be very strict with their rules, including restricting rentals, Airbnb, age restrictions, pet restrictions by weight and by breed. And of course, all of these things you can review upfront and avoid. But there are also other factors like strict renovation rules with the strata. Sometimes you're purchasing to get a good deal where you have to do some of the renovations and updates yourself, but it turns out strata may be really strict with approving these renovations. And the only time I'd recommend buying into a very strict strata is when the rules and restrictions are totally in line with your lifestyle and your values. Just make sure they match your long-term plans. And a strata with a high amount of restrictions will also affect your buyer pool, because you may be okay with some of these restrictions, but every restriction on the list is just going to carve more and more off the potential buyers of your unit. So in summary, buying a cheap condo doesn't mean more savings. A bad condo can cost you way more in the long run due to repairs, resale struggle, and hidden fees. And you can avoid these pitfalls by reviewing the strata documents and financials before buying, talk to the current residents about the building issues, and keeping resale value in mind, making sure your unit is accessible to the most amount of buyers possible. So having a simple, efficient floor plan and a strata that's not restricting the type of person that can live in there. So would you still buy a condo after listening to this list? And is there something that I missed? Let me know in the comments. I respond to everything, and I'll see you guys on the next video. Peace.